Welcome back to What's Hot and What's Not CRE, your daily pulse on commercial real estate in America. It's Tuesday, January 27th, 2026. Today we're tracking where rent growth is surging and where momentum is fading. Kicking off What's Hot, we are seeing a major comeback story in the Bay Area. San Jose is leading the entire nation with a projected 4.3% year-over-year rent growth. Right behind it, San Francisco clocks in at 4.2%. The driving forces here are pretty clear. A strong rebound in tech hiring combined with extremely limited new supply hitting the market. It seems the narrative of the Bay Area's decline was, well, a bit premature. Next up, another coastal story, but on the other side of the country. Norfolk, Virginia is also posting a very strong 4.2% projected growth. This isn't a tech story. It's a defense sector story. Steady demand, coupled with very little new construction, is keeping that market incredibly tight. And of course, we have to talk about South Florida, which just keeps performing. Miami is chugging along at 3.8% annual growth, with Fort Lauderdale close behind at 3.5%. The migration from high-tax states hasn't stopped, and crucially, they've managed to avoid the crippling oversupply we've seen in other Sunbelt markets. And for our listeners who prefer a little less drama, the Midwest is the picture of stability. Cincinnati, Columbus, Detroit, and Kansas City are all landing in that sweet spot of 3 to 3.1% growth. Chicago and Indianapolis are even a bit higher, between 3 and 3.4%. These aren't flashy numbers, but they are consistent, balanced, and reliable. All right, let's pivot to what's not. And unfortunately, the story here remains stubbornly the same for a few key markets. Austin continues to be the poster child for oversupply. We're still seeing significant rent declines as all that overbuilding collides with slowing population growth. Phoenix and Tampa are also feeling the pain. Both are projecting negative rent growth to continue through year-end, with Phoenix seeing notable declines in some of its key submarkets. And rounding out our list is Denver, where rising vacancies, especially in new urban apartment buildings, are putting serious downward pressure on rents. So what's the big picture here? Regional divergence. That is the defining story of early 2026. While the national average for rent growth is stabilizing around a healthy 2 to 3%, the gap between the winners and the losers is significant. The Bay Area and South Florida are outperforming because of one key factor: limited supply. The Midwest is delivering that consistent, steady growth. Meanwhile, markets like Austin, Phoenix, Tampa, and Denver are still working through a serious oversupply hangover. For investors, the takeaway is crystal clear. Follow the supply constraints. The markets with the best performance, San Jose, San Francisco, Norfolk, and Miami, are all leading because of limited new deliveries. The Midwest offers a lower-risk, stable return profile. And for now, it's probably wise to avoid Austin, Phoenix, and Tampa until absorption finally catches up. In this environment, market selection isn't just important, it's everything. Thanks for tuning in. See you tomorrow. Don't forget to like, share, and subscribe. Visit hotnotcre.com to learn more and subscribe to our newsletter.